Rise of the pickup in long-term yields, that is really what is grabbing the market attention, because just a short time ago we had comments coming out from Japan's Finmin also that the BOJ is indeed taking all the necessary steps in response to the long-term interest rates. Remember, we had a major rout in Japanese government bond yields. That triggered a lot of nervous tensions all around in Japan, and also spread jitters elsewhere around the region. So what's going to happen? Is the QE going to take the punch bowl away sooner than later? But let's not forget, data out of the United States overnight a little bit tamer than expected. Let's check in with Dorland, Chairman and Chief Investment Officer at Landorf West Capital Managers, joining us late as usual from New York City. Dodge, certainly one of the hardest working men out there. Why are we getting so nervous about this QE going to taper off sooner than expected, when the data from the U.S., whether it was housing starts, jobless claims, that disappointed? Shouldn't that give investors a little bit more reassurance that easy monetary policy is going to stick around a little bit longer?
Yes, Chloe, absolutely. And that's why when we've seen pullbacks in our market, they've been only pullbacks and opportunities to buy. But the concern is that there will not be enough time for the phasing out. We also agree with everyone else about the longer the Fed takes to ease and to get out of the QE program, the more likely the market will react in a very favorable sense. So we don't expect anything to happen until the third quarter. And it's more likely that Bernanke is not going to be in a rush to start the program to reducing the QE until then.
Then why is there so much nervous tension out there after Plosser, Williams, neither are voting members, and as far as we know, Janet Yellen is sort of the alter ego of Ben Bernanke, and the Fed's board is just completely filled with doves?
There is nervousness because the market market valuations have been based almost totally until recently on the fact that money is easy, and there's going to have to be a transition from market valuations from easy money to actual economic improvement and fundamental soundness of absolute companies. That transition could be rather abrupt if the quantitative easing starts sooner rather than later, and there's an expectation now that there is some likelihood that it might start sooner, given what we're seeing, the fact that tax money revenues are coming in faster, and so our debt levels are beginning to go down sooner than expected. So there is a potential for the Fed to move sooner, and the market's really not ready to have the punch bowl taken away.
Indeed, but then again, it certainly hasn't been the case of sell in May and go away. Take a look at the stellar gains. Then when should investors time their exit?
Investors should not be premature in exiting. There's more to be lost by exiting quicker and then missing out the opportunity. The market is going to tell us when it's time to exit for the short term. And from an investment point of view, Chloe, it's very important to stay disciplined. And the way we do it is to watch levels on our market. We're looking for from a short-term point of view, we're watching 15,000, which is an important level visually as well as from a technical point of view. 3388 on the NASDAQ. Levels for the Russell and the S&P also are going to be very important. For a break on all of them within a matter of within a couple of days would be an important, significant message that the market is ready to have a more significant pullback. But until that happens, it is better to stay invested, and there is very little alternative. So from a relative point of view, the markets are the best alternative at this point.
Which sectors?
Right now, it's kind of interesting because we're looking at real estate investment trusts from the yield point of view as well. Real estate from a longer-term point of view is very favorable. Retail is interesting, Chloe, not because any particular company has long-term potential, but as a sector, it is very important. It makes up for so much of the perception of economic improvement in terms of our economics. And so we're watching for the retail sector as a whole to improve. Macy's has done very well. We do have a position in Macy's. We're watching across the board, but not specific companies as much as the sector as a whole.
Okay, well, thank you so much for that. Appreciate it. We'll keep on talking about the retail space as well when we come right back. Remember.